Now coming to the next question, based on cash flow statement, a comprehensive problem of cash flow statement. Here we will prepare operating activities. We'll find out the cash flow from operating activities, cash flow from investing, cash flow from financing, and there may be in the working note we'll prepare some ledger. Okay, so the question is, from the following balance sheet of BCR Limited as at 31st March 2018 and 31st March 2017, prepare cash flow statement. So the company name is BCR Limited. So you write cash flow statement of BCR Limited. BCR Limited for the year ended 31st March 2018. This is correct. Okay, 31st March 2018. So in this question, a balance sheet is given: equity and liability, share capital, reserve and surplus, non-current liability. Under the non-current liability, long-term borrowings, current liability thereafter, trade payables and short-term provisions. In short-term provision, it has mentioned in the bracket, it's a provision for taxation. Now thereafter the assets, non-current assets and current assets. In non-current assets, the fixed assets, tangible assets and intangible assets. Tangible assets, see the working note, see the note number 1. Intangible assets, there is a equipment, and intangible assets, there is a goodwill. In note number 2, you immediately refer the notes. Note number 1 related to tangible assets, note number 2 is related to intangible assets. Thereafter non-current investment. Now under the current assets, inventory, trade receivable, cash and cash equivalent. Thereafter, in additional information, it has given proposed dividend for the previous year, proposed dividend for the year ended 31st March 2018 was at the rate of 12%, and for the year 31st March 2017, for the year ended 31st March 2017 means previous year, was 10%. Okay, was 10%. Second additional information is during the year equipment costing rupees 1 lakh was purchased. Loss on sale of equipment amounted to rupees 12,000. 18,000 depreciation was charged on equipment. 18,000 depreciation was charged on equipment. Okay, this is the related to equipment. So in the working note, you prepare the ledger of equipment first in the working note. So equipment which is given in note number 1, the opening balance of equipment, you write it this side, to balance brought down. Equipment is the assets, all assets have a debit balance. So write the opening balance of equipment, 31st March 2017 balance will be the opening for the next financial year. So this will be the opening balance, to balance brought down. And the closing balance of equipment is given in the question is balance on 31st March 2018 is the closing balance. Closing balance is also 5 lakhs. This is also 5 lakhs. Okay. So, and thereafter we will read the additional informations. Additional information number, you refer the additional information number 2. During the year, equipment costing rupees 1 lakh was purchased. So when we purchase the equipment account debit to bank account. During the year, we have purchased the equipment costing rupees 1 lakh. Okay. Next information is loss on sale of equipment amounted to rupees 12,000. So there is a loss. So we'll write it by statement of PL. Statement of profit and loss. That is 12,000 is the loss on sale of equipment. Depreciation charged on equipment by depreciation charged on equipment is, this is given, depreciation charged on equipment is 18,000. So rest figure will indicate at what price, at what value you have sold the equipment. This will be the balancing figure. This will calculate through the balancing figure. So this side total is 6 lakhs. We are going to write the 6 lakh. This side also debit side total is more. So difference indicate your sale of equipment. So this is 0 0 0 0 1 carry 3 70,000. It means equipment is sold for rupees 70,000. Is it clear? Equipment is sold for rupees 70,000. So this is the first working note. We have done it. Now coming to the first, cash flow from operating activities. Start with the number 1, cash flow from operating activities. Okay. So the profit is not given in the question directly. Profit is not given. So what we'll do, we'll see the reserve and surplus amount. So reserve and surplus given in the shareholders fund in point number B. Last year reserve was 2 lakhs and this year reserve is 3,50,000. This difference indicate the profit after tax. Profit after tax. So profit after tax is profit after tax given in the question is, we'll see that take the difference of reserve. The previous year reserve is 2 lakh and this year it is 3,50,000. So this difference indicate the profit. So 1,50,000 is the profit after tax. So we'll see that we'll take the difference of reserve and surplus. Then what we'll do, is there any other things which is transferred, which is related to PL appropriations? So one is your proposed dividend. So we will add the proposed dividend on it. We will add proposed dividend. Proposed dividend. Question is, which year proposed dividend we will add? We will add the proposed dividend of previous year. Previous year means 2017. 31st March 2017. So 31st March 2017, the dividend, you see the additional information number 1, proposed dividend for the current year 31st March 2018 was 12% and for 31st March 2017 was 10%. So we'll calculate the proposed dividend of previous year. For calculating the proposed dividend of previous year, you see the capital of the previous year. Share capital of the previous year is 5 lakhs. So 10% of 5 lakhs. This 5 lakh is what? This is the share capital of previous year 31st March 2017 at the end of the previous year. So at the end of the previous year, we will calculate the dividend of the previous year. The rate is 10% is the dividend. So dividend is 50,000 is the dividend. Okay. Then we will add provision for tax. Provision for tax made during the year. Made during the year. During the year. Provision for tax made during the year. It means current year. I am talking about the current year. So provision for tax, you see the balance sheet. equity and liability side. Point number third, current liability. B. Come to the B point. Short term provision, in bracket it has written provision for taxation. So provision for taxation of the current year 31st March 2018 is 50,000. 31st March 2018 is 50,000. This we will add. So total is 2,50,000. This 2,50,000 indicate what? Profit before tax and extraordinary item, extraordinary item. This is 2,50,000 will indicate net profit before tax and extraordinary item. Okay, so we'll take this figure, profit before tax and extraordinary item, extraordinary items before taking it, the profit is how much? 2,50,000. This figure we will take 2,50,000. So this is also a working note. This is also a working note. This one is the working note and this is the working note number 2. Equipment is one working and the calculation of profit before tax and extraordinary item is the another working note. So do the working note neatly. Okay, do the working note neatly. This is the another working note. Is it clear? Another working note. Any doubt? Now come to the what we'll do after. Thereafter we will add what we will add? Non-cash expenses, and non-operating expenses and losses, non-operating expenses and losses we will add. What will add? Non-cash expenses and non-operating expenses and losses will be added by us. Now coming to the non-cash expenses. Number one, that is the depreciation. This is the non-cash expenses. So we will write the depreciation on equipment. This is a non-cash expenses, depreciation on equipments. So depreciation on equipment is 18,000 is the depreciation, and loss on sale of equipment is a non-operating loss. This is what? This is non-operating losses. Loss on sale of equipment is non-operating loss. This is 12,000. So we will add the non-operating loss as well. So depreciation on equipment is non-cash expenses and loss on sale of equipment is non-operating loss. Both we will add it. Now see, related to, is there any other item related to over here? Is there any item apart from that? So you see the tangible assets, we have seen the tangible assets. Now you see the intangible assets, note number 2, which is related to goodwill. Intangible assets, note number 2, after the balance sheet. Just after the balance sheet, note is mentioned, given clearly. Note number 1 for equipment, note number 2 is for goodwill. When we see the note number 2 related to goodwill, last year it was 1 lakh, goodwill was 1 lakh, and this year it is 95,000. What it indicate? It indicate the goodwill written off, amortization of goodwill. So amortization of goodwill it means goodwill written off. amortization of goodwill. So goodwill is write off by rupees 5,000, amortized by 5,000. When the intangible assets write off or decrease, then we use the word amortizations. So amortization of goodwill means goodwill written off is 5,000. Is it clear? From 1 lakh to 95,000. So it is reduced by 5,000. This indicates that the goodwill is write off. So 18,000, 12,000 and 5,000. So we'll do the addition of these three: 0, 0, 0, 5, 35,000. Total is 35,000. So total after that is 2,85,000. 2,85,000. Is it clear? 2,85,000. Thereafter what we do? We deduct non-operating incomes and gains is deducted by us. Non-operating incomes and gains, we will deduct it. So find out the non-operating incomes and gains. In this question there is no non-operating incomes and gains. So I put the dash over here. The same figure continue, 2,85,000. This indicate that the operating profit before change in working capital, operating profit before change in working capital, before change in working capital. Is it clear? Then we will add, thereafter the addition will be decrease in current assets and increase in current liability. This we will add. Decrease in current assets and increase in current liability, we will deduct it. And vice versa, increase in current assets, increase in current assets and decrease in current liability will be deducted by us. Increase in current assets and decrease in current liability will be deducted by us. Now see the current assets. So current assets in the balance sheet, you come to the balance sheet. Second one is current assets, inventory. Last year inventory was 55,000 and this year inventory is 1,30,000. So inventory is increased. So increase in current assets, inventory. Here inventory is increased. So inventory is increased by how much amount? It is last year it is 55 and this year it is 1,30,000 minus 55. So it is increased by 75,000. It is increased by 75,000. Is it clear? Increased by 75,000 inventory. Coming to the next, trade receivable. Trade receivable is also increased. Trade receivable means bills receivable and debtors is jointly known as trade receivable. So last year trade receivable was 80,000 and this year it is 1,47,000 in the current year. Previous year it was 80. So see the difference, 0,007, 67,000, increased by 67,000. It is increased by 67,000. Is it clear? Increased by 67,000. Next you come to the current liability. In current liability you see the equity and liability side. The third one is the current liability. trade payable. Last year it was 1,05,000 and this year it is 1,22,000. So current liability is increased. So increase in current liability will be added. So trade payables. Trade payables is the current liability. Trade payables. And here trade payables is increased by how much amount? Trade payables is increased by from 1,05,000 to 1,22,000. 1,05,000 to 1,22,000. So it is increased by 17,000. It is increased by 17,000. It is increased by 17,000. Okay, so write the 17,000 over here. It is increased. Trade payable is current liability. Creditors and bills payable are jointly known as trade payables. Thereafter, another current liability is short-term provision, and under the short-term provision there is a provision for tax. So provision for tax statement will be done in the different manner. Here we have added the provision for tax for the current year to know the profit before tax, and the provision for tax paid during the year will be deducted at the bottom under the operating activities. So this we will add 17,000. We are going to add the 17,000. After addition, the figure is 3,02,000, and thereafter we will deduct these two because it's a less. We have to deduct. This figure is in minus, negative. So this is what? 0, 0, 0, 2, 4. 1,42,000 will be deducted by us. 1,42,000, and the figure is, after deduction, the figure is 1,60,000. 1,60,000. Is it clear? 1,60,000. So this figure is known as, this figure 1,60,000 after addition of the decrease in current assets and increase in current liability and less increase in current assets and decrease in current liability. This figure is known as cash generated from operation. Cash generated from operation. 1,60,000 is the cash generated from operation. Thereafter we will deduct the tax, payment of tax. Last year tax is going to pay by us. We are going to pay the tax of the previous year. So you see that in the current liability, provision for tax of the last year is 30,000. So we'll do the payment of tax 30,000. So it is minus. When do the payment, it is negative. So after that the figure is 1,30,000. This figure we will write it at the outer column in the main column. This column is for details. Then this amount indicate what? Cash flow from cash. This figure will indicate cash flow from operating activities. Cash flow from operating activities. Is it clear? Operating activities. This is 1,30,000 indicate what? Cash flow from operating activity. Now thereafter we will find out cash flow from investing activity in continuation of the same format. In continuations, same format will extend further. This format will extend. I am not getting space, so I move on to this side for extension. This format is extending. So is it clear? Now we are going to, I am going to calculate the cash flow from investing activities. Second is First one is cash flow from operating. So cash flow from operating is 1,30,000 cash flow from operating activities. Second is cash flow from investing activities. Cash flow from investing activities. Okay, so we'll see the investing activities. You know what are the things comes under the investing activities? Acquisition and disposal of long-term assets, okay, and investment, and in dividend received, rent received, interest received. This comes under the investing activities. So coming to the point, investing activities, for that reason we'll see the balance sheet. Which side? We'll see the balance sheet asset side. So asset side, fixed assets, you see the tangible assets. So under the tangible assets, number one is equipment is number one. So we have sold the equipment. So proceeds from the sale of equipment, proceeds from sale of equipment, how much amount we have received? Proceeds from sale of equipments, okay, we have received how much? We have received 70,000. This is inflow of cash. Under investing activities, cash comes into the business, and here it is a purchase of equipment. Purchase of equipment indicate what? It's a cash outflow. Purchase of equipment, this indicate what? This indicate the outflow of cash. So when it is a outflow of cash, so this will be within bracket. This indicate what? This indicate outflow of cash. So coming to the next, is there any things which are related to the investing activities, which are related to investing activities? In the asset side, you see the non-current assets, fixed assets, under fixed assets, tangible and intangible, and thereafter non-current investment. Last year there was no figure reflecting, previous year no figure is reflecting over here. It means there was no non-current investment in the previous year. This year it is 1 lakh. In 2018 it is 1 lakh. It means purchase of non-current investment. We have purchase of non-current investment. Money is invested to purchase the investments. So when we purchase the investments, it means it's a outflow. So it is 1 lakh. Last year there was no figure. It means last year 0, and this year it is 1 lakh. It means purchase is of rupees 1 lakh. So you do the total of these three. So total 2 lakh is the outflow and 70,000 is the inflow. So it is 1,30,000. 1,30,000. Yes, 1,30,000. So you write this figure directly. It's a outflow. Directly in the outer column, 1,30,000. It's a outflow. Okay, it's a outflow. 1,30,000 is the outflow. So what we will write over here? Cash used in investing activities. Cash used in investing activities. This much cash is used in investing activities. So cash used in investing activity is 1,30,000. It's a negative. Third activity is what? Third activity is cash flow from which activity? Cash flow from financing activities. Financing activities. Okay, cash flow from financing activity. This is the third activities. You know what is financing activities? Financing activities means change in the size and composition of owner's capital and borrowed capital. We are talking about the combination of capital, increase or decrease in the capital, whether it's a owner's capital or borrowed capital. So when we define what is financing activities, it means we are going to define the change in the size and composition of owner's capital and borrowed capital, and interest paid and dividend paid, whether it's a dividend on preference share or dividend on equity shares. Similarly, dividend on interim dividend, this comes under the financing activities. So coming to the, when we are going to see the cash flow from financing activities, change in the size and composition of owner's capital and borrowed capital, then we have to see which side of the balance sheet. We will see the equity and liability part of the balance sheet. Coming to the share capital, first one, shareholders fund. Last year shareholders fund was 5 lakhs, this year it is 7 lakhs. It means it's a issue of share capital, issue of share capital, issue of share capital. So it's a inflow. Issue of share capital indicate what? It's a inflow of cash. Last year it was 5 lakhs, this year it is 7 lakhs. So difference is how much? 2 lakhs. 2 lakhs share is issued. So it's a inflow. It's a inflow. Next is in cash flow from financing, you see the additional information number 1, it is related to proposed dividend. So payment of proposed dividend, payment of proposed dividend, proposed dividend. Okay, we will do the payment of the proposed dividend of the previous year. Current year we do the payment of the proposed dividend of the previous year, and we have already calculated the proposed dividend of the previous year. Previous year the share capital was 1 lakh and the rate of dividend is 10%. Rate of dividend was 10%. Okay, in 2017 the proposed dividend percentage was 10%. So share capital previous year was 5 lakhs and 10%, 10 upon 100, so it is 50,000. So 50,000 is the outflow. When we'll do the payment of proposed dividend, it's a outflow. Okay, it's a outflow. Now you see in the equity and liability side, point number 2, long term borrowing is there. Point number 2 in sequence. Number 1 is shareholders fund, number 2 is non-current liability. Under non-current liability, long-term borrowings. Previous year long-term borrowings was 1 lakh and this year it is 50,000. What it indicate? It indicate that the repayment, we have done the payment of long-term borrowings. So repayment of long-term borrowings, So how much amount we have paid? Last year the long-term borrowings was 1 lakh and this year it is 50,000. It means it is reduced by 50 because of repayment. So when we do the repayment of long-term borrowings, it is a outflow of cash. So finally, cash flow from financing activity is 1 lakh. So you write this figure in the outer column, 1 lakh. This is what? Cash flow from financing activities. Cash flow from, it is a inflow, cash from financing activities. You can write directly cash from financing activities, not required flow. You can directly write cash from financing activities is 1 lakh. Now the fourth step is what? Fourth step, now we'll do the total. What we'll do? We do the total of these 3 activities. we'll do the total of these three activities. Okay, operating, investing and financing will be totaled over here. Okay, we'll do the total of the financing activities. So here it is 1,30,000 plus 1,30,000 minus, so it is 0 and 1 lakh, so it's a increase. So 1 lakh increase. So we will write it over here in fourth number. We will write in fourth number, what we will write? We will write increase, net increase in cash and cash equivalent. How this we have deducted? One activity is operating plus investing plus financing, the total of the three activities. So here operating 1,30,000 cash from operating activities, cash used is 1,30,000, so 1,30,000 plus 1,30,000 minus and 1 lakh. So 1 lakh is the net increase. Then thereafter you add opening cash and cash equivalent, opening cash and cash equivalent, you add it. So see in the balance sheet, opening cash and cash equivalent in the asset side under the current assets, third one is ABC's third C number. Cash and cash equivalent previous year is 1 lakh. This is the opening for the current year. This is the opening for the previous year. Cash and cash equivalent is the opening for the current year. So you add it. After adding with this, it is 3 lakh. This must be equal to cash and cash equivalent at the end. So this one will be the sixth number. Closing cash and cash equivalent. Closing cash and cash equivalent. This is the closing cash and cash equivalent. So here it is completed. This is 3 lakhs is completed. This must be tally. After adding this net increase or decrease in cash and cash equivalent, after knowing this figure, you add the opening cash and cash equivalent. After adding it, this must be equal to cash and cash equivalent which is given in the question, that is 3 lakhs. If it is matched, it is correct. Okay. Now coming to the next question of cash flow statement. Following is the balance sheet of Mavenka Limited as at 31st March 2017. So two consecutive year balance sheet is given, 2016, 31st March 2016 and 31st March 2017. So name of the company is, you write the cash flow statement of Mavenka Limited, 31st March 2018. 31st March 2018. Okay. Cash flow statement. 31st March 2017 is the current year. So following is the balance sheet of Mavenka Limited on 31st March 2017. Two consecutive years, 31st March 2016 and 31st March 2017, information is given in the balance sheet. So in balance sheet, equity and liability side is shareholders fund. Under the shareholders fund, share capital and reserve and surplus. Reserve and surplus, note number 1 is written over there. So immediately you refer the note number 1. So note number 1, when I am going to refer, it is indicating that the reserve and surplus, it is mentioned surplus, that is balance in statement of PL 25,000 and 1,20,000. Now coming back to the balance sheet, second item is non-current liabilities. Under non-current liability there is a long-term borrowings, note number 2. Now again I referred note number 2. So under the long-term borrowings, 10% long-term loan is mentioned. Now coming back to the balance sheet, current liability, trade payables and short-term provisions. Short-term provision, note number 3. Again I referred note number 3 to see what is this. So short-term provision, there is a provision for tax. Now coming to the balance sheet asset side, non-current assets. Under the non-current asset there is a fixed assets, note number 4. Now immediately I refer the note number 4 to see what is this, what the information is given in the note number 4. So machinery and accumulated depreciation information is given. Now again I enter into the balance sheet, current assets. Under the current assets, 4 assets are there: inventory, trade receivable, cash and cash equivalent and other current assets. Now in additional information, number 1, additional loan was taken on 1st July 2016. Tax of rupees 53,000 was paid during the year. And third information is machinery of the book value 80,000. Accumulated depreciation was 20,000, was sold at a loss of 18,000. So book value was 18,000 and sold at a loss of 18,000. Prepare cash flow statement. So what we'll do first, we'll do the working note first. Before preparing cash flow statement, you draw the format of a cash flow statement first. So I have drawn the format of a cash flow statement of Mevenka Limited for the year ended 31st March 2017 as per revised standard, accounting standard 3 revised, particular detail amounts and so on. I have drawn the format. Now coming to the working note. Working note related to the first one, suppose we are going to do the working note related to machinery, related to machine. So machinery, ledger of machinery. You see the working note number 4. You refer the note number 4 to do the working for this machinery. In note number 4, it has mentioned that machinery, thereafter next line is accumulated depreciation and thereafter written down value is mentioned. I am going to do the calculation of preparing the machinery account at cost. Okay, so I will write it over here, the cost of the machine to balance brought down, opening balance of machinery. You see the note number 4, the last year figure in 2016, 31st March 2016 is the opening balance for the 16-17 financial year. So opening balance is 2,15,000. Machinery's opening balance is 2,15,000 and the closing balance of machine is by balance carried down is closing balance is 3,84,000. You know the machinery is the assets and all assets have a debit balance. So opening balance you write it over here. Previous year closing balance is the opening balance for the current financial year. This machinery account what I am going to prepare, or I am preparing it, it is for the current financial year. First of all I have written the opening balance and then this is the closing balance. Both the balance is given in the note number 4 and you refer the additional information number 3 related to machinery. Book value of the machinery is 80,000 and was sold at a loss. When we have sold the machinery at loss, so by statement of PL, by statement of profit and loss. So machine is sold at a loss of rupees 18,000. It is sold at a loss of 18,000. Book value of the machine is, I am going to calculate the profit of the loss on sale of machine, on the sale of machinery. Okay, going to calculate the profit of the loss on sale of machine. book value is given in the question is book value of the machine is how much? Book value of the machine is 80,000. And when it is sold at a loss of, I deduct the loss of rupees 18,000, it means 62,000 indicate the sale. Machine is sold for 62,000. Machine is sold for rupees 62,000. Is it clear? So you write it over here, by bank account, machine is sold for rupees 62,000. And the accumulated depreciation of the machine which was sold by accumulated depreciation of the machine sold which was given over here is 20,000. 20,000 is the accumulated depreciation of the machine. Okay. So now we will find out the difference amount, which side is more or which side is less. It is 3,84,000, 3,84,000. Now we will do the total. 0, 4, 1 carry, 16, 17, 18, 4. 4,84,000. 4,84,000. The difference amount will indicate to bank account. This balancing figure, this is the balancing figure, indicate the purchase of machinery. So machinery is purchased for rupees 9, 1 carry to 6 and 2,69,000. Machinery is purchased for rupees 2,69,000. Is it clear? Machinery is purchased for rupees 2,69,000. So first working we have done it related to machinery account. Is it clear? Related to machinery account. Coming to the next, accumulated depreciation account. In note number 4, accumulated depreciation is also given. Accumulated depreciation have a credit balance. It's a liability. So you write in opening balance, you write it this side, by balance brought down. Opening balance of accumulated depreciation, 23,000 is the balance of the last year, 23,000. Accumulated depreciation. Why I have written on the credit side of this ledger? Because accumulated depreciation is a liability. So this will be reflected in the credit side. It's a provision. It's a liability. And closing balance, you write this side, to balance carried down. Closing balance, you write it over this side. Closing balance is 48,000 is the closing balance. And here you write the depreciation of machinery sold, this one, depreciation of machinery sold by accumulated depreciation. To machinery account, you write it over here, to machinery account. What this indicate? This indicate the depreciation of machine sold is 20,000. Now you find out the difference to calculate the depreciation charged during the year. Depreciation charged during the year, total is 68. Okay, write the same amount in the credit side, 68. Difference amount indicate by depreciation account. By depreciation account, this is balancing figure. This will indicate the balancing figure. Depreciation charged during the year. So it is 45,000 is the depreciation charged during the year. 45,000 is the depreciation charged during the year. 45,000 is the depreciation charged during the year. Is it clear? This is what? This is the difference amount. This is difference amount, indicate the depreciation charged during the year. Okay. Now coming to the next working note that related to provision for tax. Provision for tax. Okay. So see the provision for tax. Provision for tax is mentioned in the equity and liability side. Short term provision, note number 3. In note number 3, provision for tax is given. You write the opening balance this side by balance brought down. Provision for tax is a liability. All liability have a credit balance. So you write the opening balance this side. So last year balance is the closing balance is the opening balance for the current financial year. So by balance brought down, and this year balance you write this side to balance carried down. Note number 3, it is 68,000. Now see in the additional information number 2. Tax of rupees 53,000 was paid. So we have paid the tax. So to bank account. Tax paid is 53,000. This is the payment of tax. So you do the total of this side. Debit side is total is more. So do the total of the debit side. It is 1,21,000. Write the same amount in the credit side, 1,21,000. Difference amount will indicate provision for tax made during the year. Provision for tax made during the year. So this will indicate statement of PL. Statement of PL. Provision for tax made during the year. This will through the balancing figure. So this will be 0,0,0,1,4. 51,000 is the provision for tax made during the year. This is for what? Provision for tax made during the year. This is very important. Provision for tax made during the year. Okay. Now come to the first one, cash flow from operating activities. Cash flow from operating activities. This 3 working is clear. Now coming to the cash flow from operating activities. So coming to the balance sheet, reserve and surplus, note number 1. So when I refer the note number 1, there is the information reserve. Surplus, that is balance in statement of PL. Last year it was 1,20,000 and this year it is 25,000. So it is reduced. So it means it's when it is reduced, so what it indicate from 1,20,000 to 25,000 it has reduced. So this indicate what? This indicate the net loss. This indicate the net loss. Difference of 1,25,000 to it has 1,25,000 to 1,20,000 to 25,000. So it is reduced by how much amount? It is reduced by 95,000. It is reduced by 95,000. Is it clear? It is reduced by 95,000. So it's a net loss. What we'll do thereafter, we'll add the tax on it. We'll add the tax, add provision for tax. Provision for tax made during the year. Provision for tax made during the year. Made during the current financial year. So provision for tax made during the current financial year is, you see, so current financial year provision for tax made during the year is 51,000. So you add it. So after addition, the figure is, this is minus, this is plus. So this is 44,000 minus. This is 44,000 minus. So this indicates the net profit, net loss before tax. Okay, net loss before tax. Now thereafter what we'll do, we'll add non-cash expenses, non-cash expenses, non-cash expenses and non-operating incomes and non-operating expenses and losses, non-cash expenses and non-operating, this is what, non-cash expenses and non-operating expenses and losses will be added by us. We will add. So non-cash expenses, first one is the depreciation. So depreciation is how much? You see the accumulated depreciation, ledger of accumulated depreciation. Depreciation charged on machinery is 45,000. Depreciation on machinery is depreciation on machinery as we have calculated, it is 45,000. It is 45,000. Depreciation on machinery is 45,000. So depreciation on machinery we have calculated, it is 45,000. So add the depreciation on machinery. There is a loss on sale of machine. The loss is this much, 18,000 is the loss on sale of machinery. It's a non-operating losses. Sale of machinery, loss on sale of machinery is 18. This figure are negative. Sorry, this figure are positive. We are going to add it. Next is, so non-cash expenses is depreciation and non-operating losses is loss on sale of machinery. Okay. Is there anything related to that? Non-operating expenses, it is interest on long-term loan. Interest on long-term loan. So we'll calculate the interest. We are going to calculate the interest on long-term loan. So interest, I'm going to calculate the interest on long-term loan. Going to calculate the interest on long-term loan. So rate of interest, you see the note number 2, long-term borrowings. Under the long-term borrowings, 10% long-term loan is given. And then you refer, related to this information, you refer the information number 1, in additional information number 1. Here it is given that additional loan was taken on 1st July 2016. So on 2016 March, the loan amount was 60,000. Loan amount was 60,000 on 31st March 2016, and the rate of interest on this loan is 10%. And this loan is up to June, the 60,000 is the loan amount. So April, May and June, we will calculate the interest for 3 months. Thereafter this loan become 80,000 because additional loan was taken on 1st July 2016 as per the information number 1, additional information number 1. So in this amount we will calculate the interest at the rate of 10% for 9 months from July to March, July to 31st March of 2017. So you will see the interest amount. So it is 1500 here for 3 months, and for 9 months on 80,000 it is 6,000. So total interest is 7,500 is the total interest. So interest on long-term borrowings is interest on long-term borrowings, long-term loan is a non-cash, non-operating expenses. It's a non-operating expenses, that is 7,500. Non-operating expenses. Okay, now we'll do the total of these three. 0, 0, 5, 0, 70. 70,500. We'll add on this figure. This is minus 44 and this is plus 70,500. So 70,500 is the plus and 44,000 is the minus amount. So difference is how much? Difference is 26,500 is the difference amount. Okay, 26,500 is the difference amount. Is there any non-operating incomes and gains? If there is any non-operating incomes and gains, will be deducted. So non-operating incomes and gains, if any, non-operating incomes and gains will be deducted by us. So is there any non-operating incomes and gains? No. So there is no non-operating incomes and gains. So I put a dash over here. So this is now the same figure will continue, 26,500. Now thereafter, this is what? Operating profit before change in working capital. Operating profit. This item is called, this amount is called operating profit before change in working capital. In short, I have written working capital. This is working capital. Okay, I am going to write the full. Working capital. Okay, this is called working capital. Now we will add, thereafter what we will add? We will add decrease in current assets and increase in current liability, and vice versa will be deducted by us. Increase in current assets and decrease in current liability will be deducted by us. Okay, will be deducted by us. Increase in current assets and decrease in current liability. Increase in current assets and decrease in current liability will be deducted by us. Now see, come to the current assets. Under current assets, you see balance sheet asset side. Current assets is inventory. Last year it was 60, this year it is 67. So inventory is increased. Inventory is the current assets. So we will write inventory over here. Inventory. This will be deducted. Inventory is how much? Increased by 7,000. Inventory is increased by 7,000. Next is trade receivable. Last year it was 65 and this year it is 51. So trade receivable is decreased. So decrease in current assets, trade receivable. Trade receivable is a current assets. Here the current asset, trade receivable is decreased by 14,000 from 65,000 to 51,000. From 65,000 now it is now 51,000. So it is reduced by how much? It is reduced by 14,000. Thereafter current assets, D number is current asset. Last year it was 4,000 and this year the figure is blank. It means this is decrease. So decrease in current assets means other current assets is decrease. Other current assets. Other current assets. This is also decreased from 4,000 to 0. So it is 4,000. Now coming to the current liability, you come to the equity and liability side, see the trade payables under current liability. Last year it was 20,000 and this year it is 6,000. So trade payable is decreased by 14,000. So decrease in current liability. Trade payable is decreased. Trade payable is current liability. So trade payable here it is decreased by how much amount? It is decreased by, trade payable is decreased by 14,000 from 20,000 to 6,000, reduced to 6,000. It means it is decreased by 14,000. Next is your short term provisions. Note number 3, we have seen it is related to provision for tax. Okay, it is related to provision for tax. So any other item? Now what you will do, you do the addition, 18,000 you add it. So after addition the figure is, we'll do the addition 18,000. Okay, we'll do the addition. So this is 0, 0, 5, 4, 4, 44,500, and thereafter we will deduct 21,000. We will deduct it. This is minus. So 21 we will deduct it. So 0, 0, 5, 3, 2, 23,500. 23,500. Is it clear? 23,500. So after deduction of this, it is 23,500. This is known as cash generated. Cash generated. Cash generated from operating activities. This is what? Cash generated from operation. Cash generated from operation. Okay, cash generated from operation activities, operating activities. Thereafter the last part is you deduct the tax less payment of tax. Payment of tax. We will deduct the payment of tax. And for that you see the provision for tax, ledger of provision for tax, payment of tax is 53,000 is the payment of tax. So this 53,000 will be deducted. 53,000 will be deducted within bracket 53,000. Okay. So the rest amount is 005 00592 29,500. It is coming 29,500. This is your cash flow from operating activities. Cash from operating activities. Cash flow from operating activities. Cash from operating activities, that is 29,000. It is in minus. So it is cash used. You write the cash used in operating activities. Cash used in operating activities. Cash used in operating activities 29,500. It is in minus. So it is cash used. Write in the outer column. Write the amount in the outer column. So after deduction of payment of tax 53,000 from the cash generated from operating activities, the final is cash used in operating activities 29,500. It's a negative figure. It's a negative figure. You write it over here, cash generated from cash flow from operating activities, and here it is cash used in operating activities. Now coming to the next, cash flow from second activities. First activity is cash flow from operating. Now coming to the next, cash flow from investing activities. Cash flow from investing activities. Okay, this is the second activities, cash flow from investing. For investing activities, we will see the asset side. Okay, in the balance sheet, asset side. So asset side, fixed assets, note number 4. When we refer the note number 4, we have done already the calculations. It's a sale of assets, sale of machinery. Sale of machinery is 62,000. So this is inflow of cash. Here the purchase of machinery is the outflow of cash. Purchase of machinery is the outflow of cash and cash equivalent. Okay, 2,69,000 is the outflow. Outflow I am indicating in the bracket. Okay, outflow I am indicating in the bracket. So sale of machinery is 62, purchase of machinery is 2,69,000. And any other assets which we have purchased or sold over here related to investing activities, any other assets which are related to this? No? Only these two items are here. You add this one minus 2,69,000 and plus 62. So figure is 0,00702. 2,07,000 it is minus. 2,07,000 is the minus. So you write the amount in the outer column 2,07,000. This is what? This is in minus. So you write cash used in investing activities. Cash used in investing activities. Okay. Now coming to the third one, cash flow from financing activities. Cash flow from financing activities. Okay, this is the third activities, cash flow from financing activities. For financing activities, we will see the liability, equity and liability side of the balance sheet, because it is related to change in the size and structure of the owner's capital and borrowed capital, composition of owner's capital and borrowed capital, and it is related to interest paid, dividend paid, interim dividend paid. So we will see the equity and liability part. Share capital, first one is share capital. Last year the figure was 1 lakh. This year share capital is 3 lakhs. It means share is issued. Issue of share capital. Proceeds received from issue of share capital. Is it clear? Proceeds received from the issue of share capital. How much we have received? It is 2 lakhs. Last year figure was 1 lakh and this year it is 3 lakhs. So it is increased by 2 lakh. This increased figure indicates that the shares are issued this financial year. Next is long term borrowings. Last year 60,000, this year 80,000. So proceeds from long term loans, long-term loans. Proceeds from 10% long-term loans, 10%, proceeds from 10% long-term loan. Last year the figure was 60, this year 80, so it is increased by 20,000. This is also inflow. This is also inflow. Thereafter you see, is there any information related to the cash flow from financing activities? Interest on long-term loans, long-term loans. This is what? Payments, payment of interest of long-term loans. It is payments. Payment, how much it is? 7,500. We have already calculated 7,500. It's an outflow. When we do the payment, it's a outflow. So there is 2 inflow and 1 outflow. So 2,20,000 minus 7,500. So this figure is indicating 2,12,500. 2,12,500. 2,12,500. This is what? Cash flow from financing activities. Okay, 2,12,500 in the outer column. Now we'll do the total of these 3. First one is 29,500 is minus, cash flow from operating is minus. Second one, cash flow from investing is also minus. So total minus figure is 2,36,500, and now you deduct the inflow. So it is 0,0042, 24,000. It is 24,000. So what we'll do now? So cash flow from operating used, financing used, and investing used and financing is plus. So 2 are added and 1 is deducted. So total is this much is used. So fourth one is net decrease in cash and cash equivalent. Cash and cash equivalents. This is what? 1 plus 2 plus 3. 1 is what? Operating, investing and financing. Now we are going to do the total of these 3. So in these 3 activities, the first one operating minus, investing minus and financing plus. So total is 24,000. It is minus. It means net cash decrease. That's why I have written net cash decrease. It is in minus figure. If it is in plus figure, then we will write net cash increase, net increase. Now fifth number is opening cash and cash equivalent. Opening cash and cash equivalent. You write it, which is given in the balance sheet. Cash and cash equivalents. Opening. How much it is? Opening, you see cash and cash equivalent in the balance sheet, current assets. Point number C, it is 49,000. It is 49,000. So we'll deduct it. This is 24 minus and this is 49 plus. So net resultant will be closing cash and cash equivalent, closing cash and cash equivalent, okay. So when we deduct it, 49 plus 49 minus 24, so it is how much? 25,000 plus. So you see in the balance sheet, cash and cash equivalent in the current year is 25,000. It is correct. So cash flow statement is completed by us. Cash flow statement is complete. Is it clear? Cash flow statement is completed over here. Any doubt? Cash flow statement is completed. Here I have prepared the machinery account at cost. Here I have prepared the machinery account at cost method. If you want to prepare the machinery account at written down value method, then you can also prepare. So I am showing it. If the machinery is going to prepare by written down value method, if the machinery is going to prepare by the second method, then how this will be prepared in the second method. Okay, going to explain the second method of preparation of machinery account. Second method, machinery account from second method. Which method I am applying? Written down value method. Written down value method. So when we are applying the written down value method, through the written down value method I am going to prepare the machinery account. You see the working note number 4, notes to account 4, accumulated depreciation, machinery and accumulated depreciation. After deduction of that, the figure is 1,92,000 and 3,36,000. So I will take this figure to 1,92,000. I will take to balance brought down. I will take 1,92,000 means written down value figure I will take over here, and in the closing I will write by balance carried down. I am going to take the closing figure. 3,36,000 is the closing figure. 3,36,000 is the closing figure. I am going to take this figure. So here what we will do, we will write the depreciation, okay, this side by statement of PL. When we have sold it, by statement of PL, profit and loss is 18,000, by statement of PL 18, by bank account 62,000. Here I am not going to write the accumulated depreciation 20,000. I am going to write the depreciation charge during the year by depreciation account, by depreciation account 45,000. This is the depreciation charged during the year. Depreciation charged during the year. Is it clear? Now we'll see the difference. You do the total. Total of this side is 0, 0, 0, 10, 15, 15 and 6, 21, 1, 2 carry, 7, 2, 9, 9, 13, 13 and 3, 16, 1 carry, 4,61,000. It is 4,61,000. 4,61,000. So difference amount will indicate to bank account. This is the balancing figure is bank account. Balancing figure. This is what? Balancing figure. So balancing figure is how much? 0, 0, 0, 9, 1 carry, 6, 2, 2,69,000. You see the same figure is here, 2,69,000 by written down value method, and by at cost method it is the same figure. So either you apply this method or this method, it is immaterial. Which method which is suitable for you, you can do it easily. You apply that method, but the resultant will be the same. If the student applied at cost method while preparing the machinery account, you prepare like this. If you want to apply the written down value method to prepare the machinery account, you apply the written down value method. Okay, but the final things will be the same. Whichever the method you will apply. So is it clear? Any doubt?